We're actually getting into some of the most exciting times around the stock market. And that's because the whole market is falling. At least all the small caps as well as growth stocks. And we're even seeing some of those dividend paying blue chip stocks starting to come down. And that's because of various reasons out there. Things like fears of inflation, the Omicron variant, as well as some political issues happening around the world. There seems to be a lot of fear on the market right now, and this makes for some great buying opportunities. So in this video today, we're going to be going over my TFSA portfolio, just like every single Monday we do this. On top of that, I'll be discussing bank stocks today because all the big six banks in Canada this week reported earnings, and there were some very interesting insights that I pulled out from bank stocks that you'll want to stick around for. National Bank is the bank that I'm going to be adding to this portfolio throughout 2022. I'll also explain what type of investor is suitable for each of the big six banks, so that will come later on this video. By the way, if you guys are new here, my name is Daniel, and here on this channel, we talk about stock market investing. So if that's something you're interested in, as well as you invest in Canadian stocks, this channel is focused purely on Canadian stock market investing. So hit that subscribe button down below. This week's video sponsor is Cantech Letter. If you go to the website www.cantechletter.com, you can get top picks from dozens of different analysts. Whenever I'm doing a research on an existing stock in my portfolio or a new Canadian stock, Cantech Letter is one of the first places I go to do some research. Because their articles are informative, they have analyst opinions, and it's not just a bunch of fluff like Motley Fool. So for that reason, I highly recommend you guys go check out their website and sign up for their newsletter. All right, now let's jump over to my computer and talk about the TFSA portfolio. So we're here on the main page where I show my entire portfolio and all the metrics that I've developed associating with the portfolio. Currently, the total market value is $9,653, and that's actually less than last week. That's because this entire week, the total market has dropped by 3.16%, and my portfolio was not immune to that either. So my portfolio did see a drop in value somewhere around $200 to $300. In total, since I started this portfolio since March 16th, for those of you guys who are new to my journey, I've gained 1.72%, and the entire dollar amount that I'm up is $162.97. If we compare that to the TSX is up 8.74% since March 16th. However, I don't track just my portfolio against the TSX since March 16th. I actually track this portfolio against every time that I buy a position. So you'll see later on when we go to the Wealthsimple Transactions tab, every time I buy a position, I also log it as if I were actually buying a TSX ETF instead of the individual stock. So tracking it that way, if I were to have invested in the index versus all these different positions that I have, I'm actually down compared to the index by 2.7%. I think that there's more to investing than looking at the current stats of the portfolio, because the markets go up and down, and my portfolio is not like a stable dividend portfolio either. I have some high growth stocks which are relatively more risky, where we see a lot more volatility, as well as I do hold some dividend plays and I hold some safer stocks like that. So now let's jump over to the transactions tab and see which stocks that I bought this past week. So I've highlighted the lines where it shows each of the individual transactions that happened this past week. So I bought D2L on two different occasions, buying 2 shares each time, with an average cost basis somewhere around $16.50 if we average the 2 transactions out. I also bought Borrowell Technologies and continued to buy this for the past couple of weeks or so. I bought 3 shares on one day for $6 a piece, and then later on in the week, I bought 2 shares for $5.23. You can see that I'm taking small nibbles at Borrowell Technologies. I'm not buying large chunks because I think the price is cheap. I think that there still could be more for this company to fall, because right now we're in a market where everyone's dumping all their small cap stocks. So it's possible that Borrowell could continue to decline, and that's just because of all the selling pressure. When you think about what's happening in the market and why are people selling off these companies, the first thing you got to understand is that these small caps usually generate a lot less volume, meaning that maybe only 1% or less than that of the entire float or all the stocks out there for this company are being traded each day. And the price is determined based on the last time someone decided to do a transaction. So a buyer and seller decide to transact for a certain price. That's what determines the actual stock price. So yes, let's say 99% of the holders out there are long-term holders and they're not planning to sell. However, there's 1% where they're just trading the stock back and forth. that 1% could cause the stock to drop significantly because they're the only buyers and sellers in the market. So I think that WELL Health right now is getting affected by all the short-term trading where people are jumping in and out of the stock. And you see this happen more with small cap stocks. The third stock that I bought this past week was Air Canada. And I bought it for $20.67 per share, and I bought 2 shares of Air Canada. So I think Air Canada could continue to see more dropping if the entire market is still selling off. On top of that, we have COVID fears, which are major headwinds for Air Canada, because when COVID ramps up, people don't travel. Lastly, I bought 1 share of Enghouse. I paid $52.42. And I've talked about Enghouse here and there, and I've been buying their stock here and there as well. Every time it drops to the $52 or $53 mark, that's where I like to scoop up a share or two here and there. And that's because I've been watching the stock and just seeing it trade fairly range bound between the low 50s and low 60s. So when I see in the low 50s, I see it as another opportunity to pick up more shares of this technology stock that also pays a dividend. I also received a dividend from Enghouse at the end of November. I received $2.08. So the stock that's up the most is Data Communications Management Corp, up by 2.7%. And then we've got TD Bank in second place, going up by 2.14%. But if we go to the other end of the scales and we look at the bottom, let's see our biggest losers. We've got Good Nature Products, we've got Shopify, Kinaxis, and WELL Health Technologies coming in at last place, dropping 12.71%. I know that some of you guys have been commenting like, why is WELL bleeding? Well, I mentioned earlier, it's because of all these short-term traders coming in and trying to push down the price. And this is when a lot of those bullies in the market or people who are doing somewhat illegal stuff are trying to play these small caps to make a gain off of it. It's possible that we're seeing this kind of activity. And right now, because WELL Health Technologies is not really in the limelight and nobody's really talking about them, then these traders who are doing these different strategies have free reign. There's no retail traders, there's no hype that's going to get in the way of these guys who are shorting the stock. Now, looking at this portfolio holistically, you can see that percentage returns are kind of all over the place. Some stocks I'm up like 31%, but other ones I'm down 28 or 24% on those positions. And honestly, investing is a learning curve and no one can ever predict what's going to happen in the market. So when I decided to buy into these positions that are down, I full well knew the risk that I was taking in buying these positions. A lot of these companies are smaller cap companies with not as much press, therefore not as much marketing and less buyers and sellers out there. But I think in the long term, their business strategies are going to be able to prevail and the company will continue to grow its revenue. And eventually investors will take note, pick up on this and start buying into the stock. So I'm not in these positions for the short-term gains, but I'm riding it out for the long term and dollar cost averaging every single opportunity I get because I do see value in these companies and their business models. It's just that the stock price might not always align with what I think it's valued at. But in the long term, if the business continues to perform very well, then investors will take note of this and eventually catch up and buy the stock and bid the price up. Now jumping over to the big 6 banks in Canada because they just released their earnings, and there's some pretty interesting findings that I found through analyzing their financials and their metrics, which I'm going to share with you right now. So at the top here, we've got Royal Bank, TD, Bank of Nova Scotia, BMO, CIBC, which ticker symbol is CM, and National Bank, which is NA. I've listed the earnings dates at the top over here, and I've compared the prices of these banks since their earnings date versus today. You can see the performance right over here. The bank that did the worst since they released their earnings was National Bank, and it's down by 4.1%. The bank that did the best is Bank of Nova Scotia, and it's up by 3.3% since it reported earnings on November 30th. I've also done a comparison since the first bank released their earnings, which is the Bank of Nova Scotia. And you can see the stats here are relatively the same. Funny enough, National Bank actually fell a little more than when they reported their earnings. They've fallen 4.73% since November 30th versus December 1st. I also did a couple other comparisons relating to the time of the pandemic. So I looked at just before everything crashed before the pandemic, and the crash started on February 21st, 2020. And the lowest point, which is March 20th, 2020, I compared those two prices. We can see that BMO and the National Bank of Canada are down the most by about 38.6%. And then the banks that did the best are Royal Bank and TD, where they only were down 24 or 26%. On top of that, I took from March 20th versus today's stock price and to see which bank gained the most since the lows of the pandemic. And the stock that gained the most was BMO, going up by 122.5%. Second place was National Bank of Canada at 110%, and then we've got CIBC in third place going up by 88%. I also have tracked the 1-year, 3-year, 5-year, and 10-year performance of these 6 banks. And the clear loser here is Bank of Nova Scotia. It's always lagging the other banks. And then in first place, we've got National Bank, which has had the best performance over 10 years, 5 years, and 3 years. The 1-year performance winner is BMO at 41.2%. But National Bank of Canada also didn't do too shabby. It just got surpassed by TD and it came in third place. So the question I have now is, why is National Bank doing so well compared to the other banks? So here's some clues as to why National Bank is possibly one of the best stocks to invest in for growth stock investors. First of all, it's got the smallest market cap at $32.46 billion versus the largest bank here, Royal Bank, at $142 billion. And the reason why a smaller market cap bank might do better than their larger counterparts is because smaller cap companies are a bit more nimble. There's less bureaucracies and they can get things done a lot quicker. Management in these smaller cap companies always have big fish to look up to, and they're trying to reach the top. So they're going to employ some more riskier strategies in order to try to increase market share. And we know in the Canadian banking sector, it's quite saturated right now. There's practically no one out there except for newborn kids who don't have a bank account. So all these 6 banks plus other fintech players out there are trying to take from a market that's fully saturated. In order to do that, you have to give special promotions or offer certain incentives to bring customers over from a competitor into your bank. So National Bank is heavily trying to use some sort of marketing techniques to bring in new clients in order to grow their market share. And being a smaller bank, it's a lot easier for them to increase their revenue as well as net income because they have more people to steal customers from. If you're already a large bank and maybe you own 20 or 30% of the market, it's very difficult to go and grab the same percentage of customers versus the bank who only has maybe 5% of the market. If you want to increase your market share by 100%, the 5% bank has to increase to 10% of the entire market. But if you're a bank who owns 20% of the market, you have to grow your market share by another 20%, which is very difficult to do. And that's potentially why National Bank has been outperforming its peers. We can go to this other tab where I've tracked revenue growth, net income growth, as well as EPS growth. And we can see that National Bank, they're always a clear winner. Their 5-year average EPS growth is 25% compared to the competitors, which are pretty much half of that. And their average EPS growth since 2013 is an 11%, which also tops all their peers. If we look at their net income, they've grown their net income by 25.2% in the past 5 years. And in the past 9 years, they've grown their average net income by 11.3%, again, topping all their peers. And if we look at revenue, they've grown their revenue by 11.14% in the past 5 years. In the past 10 years, they've grown it by 7.52%. They did come in second to BMO here. However, it seems like their net income is a lot higher than BMO, meaning that they manage their expenses better than BMO. And if we look at the biggest loser across here, it's no surprise that it's Bank of Nova Scotia. They lagged in revenue growth, net income growth, as well as EPS growth compared to their competitors, which is no wonder why the stock performance has underperformed the rest of their peers. However, there's always an appeal to some investors why they might want to invest in BNS versus the other 6. But here, I'll give you my analysis on each of the 6 banks and what kind of investor I think would benefit from investing in each one. The first one we're going to talk about is the investor who has a higher risk tolerance. It's no doubt that National Bank would fit the profile of someone who's got a higher risk tolerance. They are a smaller cap bank, which makes them slightly riskier because they don't have as much market share and they might see a bit more fluctuation in their business compared to their counterparts. However, it's shown it's had the best growth over the 3, 5, and 10-year previous period. And the 1-year performance isn't too shabby either. And being the smallest cap bank out of these big 6, it's easier for them to grow their clientele base versus their larger counterparts. BMO is the second stock that I think would fit a higher risk individual's profile. BMO has also had pretty stellar growth over the past 10 years, and its 1-year performance came in at a stellar 41.2%. Its market cap isn't the largest, it actually comes in the middle of the pack for these big six banks, so they do still have more room to grow to try to grab more market share from the bigger boys. BMO also pays out a fairly decent dividend compared to National Bank at 3.9%. National Bank, I forgot to mention, only pays out a 3.6% dividend, which is the lowest among its peers. But if you're a higher risk investor, you don't really care about the current percentage. What you care about is the dividend growth. And we can see that National Bank and BMO had the highest dividend growth in this past year. National Bank increased their dividend by 23%, while BMO increased their dividend by 25%, which was the highest of the group. They also have fairly reasonable PE ratios, and they're in the middle or the lower end of the pack at around 10 or 11. Now moving on to the other end of the spectrum, we've got the low risk investor. If you're a lower risk investor, I'd say Royal Bank and TD Bank are the banks that you would tend to go for. Because first of all, they're the largest market cap, so they have pretty much dominance in the Canadian banking sectors. They tend to be generally more stable out there, and the fact that they're the largest cap banks, they have both consumers as well as businesses banking with them more often than not. Their revenue growth is pretty much middle of the pack all the time, although the 10-year growth is pretty impressive and they came in second and third place, growing by 161 and 160% each. Their dividends are on the lower to middle end compared to the rest of the banks, and that's probably because a lot of investors are currently flocking to Royal Bank as well as TD Bank, looking for a bit more safety or stability while the market is shaky right now. So that's why their prices have been bid up. They don't increase their dividends as much. They increase them by 11 and 13%, which is still a decent increase, but not as great as BMO and National Bank. We can see that the market cap of both these banks are in the hundreds of billions of dollars, and they have a PE ratio of 11 or 12. They're more on the higher end when it comes to PE ratio, and I think this is, again, investors trying to look more for safety and putting their money into these largest cap banks. As well, we can see they didn't drop as much compared to the other four banks in the pandemic. They only dropped by 24 and 26% versus the mid-30s for the other banks. Looking at the net income increase year over year, they don't perform as well as the smaller cap banks. And TD especially, TD Bank definitely lagged the entire pack by a significant amount. They only grew their net income by 20% year over year. I'm kind of surprised that the stock is still up by 1.9% since they reported their earnings on December 2nd though. Now the case for someone to invest in Bank of Nova Scotia or CIBC is this. Bank of Nova Scotia has been underperforming its peers, and there's no doubt about that. However, there's one thing that you guys probably don't know. Bank of Nova Scotia actually does quite a fair amount of business in Latin America. And that's probably what makes it a little bit more risky compared to the rest of the banks here, because Latin America could have a lot of geopolitical issues, and that causes a lot of instability in their banking sector. However, because this country is still developing, it's possible if Latin America gets its stuff together and moves away from being a third world country to being a developed country, then Bank of Nova Scotia could really hit a gold mine there. And as an investor, you would be rewarded handsomely. However, that's the big if there. CIBC also is a laggard amongst the group with fairly mediocre growth numbers compared to their peers. However, CIBC I saw has done some rebranding recently, trying to become a less archaic bank, and I think that they're headed in the right direction. In the short term, it might have worked its magic, seeing a net income increase year over year by 68%, and that's the highest of the pack. So CIBC could be onto something, but we're in the early innings of that. So if you are an investor who wants to take a little bit of risk, but not as much risk, then CIBC might be a bank you want to consider. On top of all this, if you invest in Bank of Nova Scotia or CIBC, you get a juicy dividend of 4.3 or 4.6%. So these are by far the largest dividends that you can get from a Big Six Canadian national bank. So for those people who are looking for dividend income, CIBC and Bank of Nova Scotia would fit their bill. So now you've heard my analysis on Canadian banks, I'd love to know your thoughts down below on if any of these banks are on your watch list or you're planning to buy more this next week. For me personally, I might actually consider adding National Bank to this portfolio because National Bank pays a fairly solid dividend, as well as they've shown a history of growth. And I wouldn't have known this if I didn't put in the work to analyze all 6 of these banks and compare them side by side. I personally bank with TD and just have been comfortable investing in TD stock, but after looking at this spreadsheet that I made, I've changed my mind and I think that National Bank does deserve a position in my portfolio. That's all I've got for you guys this week. If you enjoyed this episode, be sure to leave a like down below. I've got 2 videos up on the screen here. If you're interested in those, you can check them out. If not, keep up the grind and have a great day.